Okay, we'll look at this question. This is from October, November 2009. Yeah. Right. Rashida has a business selling office machine, office supplies, and stationery from her warehouse. So they want to know what's happening here. Now, there's tangible fixed asset, intangible fixed assets, and current assets. Now, tangible fixed assets is basically assets that you can see. You can literally hold them, right? Intangible fixed asset, on the other hand, you know it's there, but you can't see them. You can't really hold and see that it's being there. Now, an example of an intangible fixed asset would be goodwill. What is a goodwill? Goodwill is basically the name you have created for yourself or for the business. For example, let's say you've been running a bookshop. For an example, you've been running a good bookshop right now and you want to sell them. When you go and count all your assets in the business, you realize your bookshop total asset is about 20,000 ringgit. Now, will you be selling it at 20,000 or more?
More?
Why more? You know, your asset is worth only 20,000, but why should you want to sell it more at more than 20,000? And why would other people would want to buy it at more than 20,000?
Because of the goodwill of your business.
Yes, the goodwill of the business, because you have already got existing clients. You have already got existing customers coming in and getting the book. So someone else who's buying the business, they don't have to start from scratch. They know the business will run. People are coming to ABC Bookshop, not because the owner has changed, right? So that is what we call as goodwill. It's an asset, but we can't see them. So that's an intangible asset. Motor van will be a fixed asset. Nowadays, we don't use the term fixed asset. We call them as non-current assets, right? Now, warehouse is also a non-current asset, whereas stock is a current asset. So what's the difference between non-current asset and a current asset?
Non-current assets, you don't sell. You don't consider them as sale when you sell it. But current assets are things which you buy to resell.
No,
For
not necessarily resell. So that means you're telling me bank is a current asset, then you can resell your bank?
Wait,
No, it
no,
doesn't work that way.
that's
Now,
not correct.
what is a non-current asset is basically assets that last you more than 1 year. The value doesn't change in more than a year. Like when you buy a motor van, the cost is 20,000. Until you sell it 5 years later, the cost is still 20,000, right? Whereas in current asset, the value will go up and down. Today you have stock for 4,000 ringgit and then you sell some at 1,000. At the end of the day, your current asset decreases to 3,000. Then tomorrow you buy more stock. Then your current asset increases. So the value of your current asset will go up and down, right? So that's the difference between current assets and non-current assets. Non-current asset, the value would not change within a given year, whereas current asset, the value changes often. So your bank value is the same thing, right? Today you have more cash in the business, tomorrow you pay off your supplier, you have lesser cash in the business. So the balance fluctuates. Okay, so that's how you explain current and non-current assets.
Okay.
Now let's move on to this one. Cleo is in business and prepares her accounts on 30th September each year. So her financial year is very important. When is it? 30th September. On 1st October, that means her financial year, if I were to write it down, it ends on 30th September. So it must begin on 1st October. On 1st October 2008, she bought this, yeah? So ending must be 2009. On 1st October 2008, she bought a new photocopier from Rashida for 2,100. Cleo decides to depreciate the photocopier over 3 years using straight line method. That's pretty easy. The scrap value, another word for scrap value would be residual value of the photocopier at the end of this period is 300. Calculate the amount of depreciation to be charged in Cleo's profit and loss account. Another name for profit and loss is income statement. Now, you must remember this is an old paper, 2009 paper. Later part in 2015, they actually updated the format. So no longer we call it profit and loss, income statement. Okay. For each of the 2 years ended 2009 and 2010. All right, now let's see how much is the depreciation per year first. So depreciation per year using straight line method, there's two ways to do it, right? One is using the percentage, the other one is using the formula. Formula says cost minus scrap value divide by number of years. So the cost here is 2100. The scrap value here is 300 and number of years here is 3. So that should give you 600 per year, right? So that's your depreciation. Now, they want you to do for each year ending 2009 and uh, 2010. So 30th September 2009 and 30th September 2010. So this is a copier. What's the amount here? 600 and 600. So this is your depreciation amount. That's easy. Let's look
Yeah.
at C. So depreciation account. So how do you do depreciation account? You need to know the debit entry and the credit entry. So for depreciation, debit would be income statement, because why? Depreciation is a form of expense. Expense and income goes into income statement. And remember, provision account is always credited. So we would credit our provision account. Okay, I need this space. I will take it up. So when is it happening? They want us to prepare for how many years? They want us to prepare for 2 years. So we start with 2009, September 30th. Income statement was 600, right? So that's it. We are done. Now we have to close the account and bring it forward on the same day, because September 30th is the last day. Balance carried down would be 600 as well. Always end your account with a brought down. October 1st, balance brought down would be 600. Then September 30th again in 2010. Sorry, this is 2009, right? So the next account will take place in 2010, September 30th. How much is it? Income statement would be 600. So your total carried down would be 1200. When was this? 2010, September 30th. Now your dates are very important, because in exam sometimes dates you are given 1 mark for it. Now, is this over? No, it is not over. Why? Because you still have to bring down your account on October 1st. Balance brought down 1200. Now this is how you do your provision. Now the next question. Now balance sheet. Another term for balance sheet would be SOFP. This is an older term. Now we call it as statement of financial position. So here we can write it as copier or photocopier, doesn't matter. The cost was how much again? The cost?
2100.
100. So the cost was 2100 on 2010. The total depreciation was 1200. So net book value would be a 9.
Uh,
I don't have a calculator with me. How much is it?
900.
There. Okay, now we look at the next question. This question is from May, June 2016. Question number 4. Virginia depreciates motor vehicle at the rate of 25%. Now you're using reducing balance method. Now the most important here is they say it's a full year depreciation in the year of purchase and none in the year of disposal. Her accounting year ends on 31st December. So she purchased a motor vehicle 10,000 on 1st April 2013 and sold it in May 2015. So this is your cost price, this is your selling price, right? On the same date, she bought a new motor vehicle, 17,000 by paying the check. So they want to know the depreciation which has been provided on the motor vehicle at the date of disposal right now. 1st April 2013, so you know it has to be 31st December 2014. You will do one depreciation. And would you do a depreciation in 2015? No, sorry, 2013, yeah? 2013. And 31st December 2014. Would you charge depreciation in 2015? No depreciation because they say no depreciation in the year of disposal, right? And one full year depreciation in the year that we bought. So here the depreciation rate will be 25% times 10,000, which is 2,500. Now, second year, because it's reducing balance method, basically it will be 25% times 7,500. Why is it 7,500? Because we must take the formula for reducing balance method is cost minus net book value times the percentage. So the percentage is 25%. The percentage is 25% and your cost was 10,000 minus the total depreciation, not net book value, total depreciation, right? So total depreciation to date is 2,500. Okay. So 7,500 times 25% will give you how much it is?
One 1,875.
1,875. There you go. So these are the depreciation. So what's the total depreciation then? Total depreciation would be 4,235. Any problems so far?
Uh, no problem.
Okay, now let's move to how do you do the motor vehicle? Only on December 2015. So the month that we sold. So January 2015. So we will start on 1st January 2015. So because it's an asset account, balance brought down will be on your debit side. So 2015, January 1st, balance brought down, motor vehicle will be 10,000. So on 2015, when we sold the asset, we sold it on May 28, we send it to disposal 10,000. Now remember, this is an asset account. We have to take away the disposal at the cost value, which is 10,000. Okay, now from here, what we do, we also bought a new one on the same date, right? May 28, it was 17,000 using check, isn't it? So bank 17,000. How you do close the account? 27,000. So 17,000 is your carry down. When is this? December 31st. So on 2016, January 1st, balance brought down would be 17,000. So you see now your T account reflects the new asset that you have in the account. The old asset has been sent to disposal. Now let's look at the provision. So provision is always credit, right? So your balance should be on your credit side. So on 2015, January 1st, balance brought down would be the total depreciation till date, which is 424235, right? 4235. Now, what happened here? We also sold the machine. Now, sold the vehicle. Now, when we sell a vehicle, we have to take it out from your asset account. We also take out the total depreciation from the depreciation account as well, because the asset is no longer there. So when the asset is no longer in the business, we have to move it away from the T account. So here we will send them to disposal 4235. But you have a new motor vehicle, right? Which you bought it at 17,000. So 17,000 times 25% for the depreciation. How much is the value? 17,000 times 25,
4,250.
4,250. So this is the depreciation for the new vehicle. Let's call that P in a sense. So here on December 31st, as we mentioned earlier, you have to transfer it to income statement 4250. Then we can close the account. So this will be 8485. So 8485. 4250 is your carry down on December 31st. So 2016, January 1st, balance brought down would be 4250. There. Can you understand? Do you need me to explain it again?
Oh yeah, now that you explain, I understand. But previously, I was quite confused on the T account part, how to do it. Yeah.
Okay, so once we are done with this, we can do the disposal account. Now remember, if you look through my other videos, yeah, you can also go check it out in the YouTube channel. I have given step by step how to do the disposal account. So if you check that out, I've also given this mathematical equation where you can find whether there's a gain or loss of the disposal. How do we find them? We just look at the selling price, compare it with net book value. Now the selling price of the motor vehicle is how much? How much we sold it for?
Uh, 7210.
Okay, so this is the amount we sold it for. So the net book value is cost 10,000 minus total depreciation, which is 4235, right? Okay, so how much is this net book value? So 7210. Net book value would be
Would be 5,765.
5765. Okay, so you see your selling price is more than the book value, right? So when your selling price is more than the book value, then we say the account, when we actually sold this motor vehicle, we had a gain on disposal. Okay, this is a mathematical way of doing it without doing the T account. Now, if it's a T account, remember earlier from your motor vehicle, we credited it, right? Credited to disposal account. So here, we would debit your disposal account. When was this? May 28, 2015. We would write here motor vehicle. The actual amount was how much? 10,000. Then we also did the provision account. We debited our provision account to send it to disposal. So here, May 28, here it would be provision. How much was the provision? 4235. And when we sold it, we receive a check, right? So bank. So when we receive a check in the bank form, we would debit our bank and credit our disposal. So here, bank, how much is it? 7210. Okay. So it's going to be 11,445 total. So here 11,445, right? So how much is the gain in disposal? The difference between these two, which is 1,445. We send it to income statement. Okay? Was it difficult?
Disposal account part was new to me. Yeah.
Oh, we have not done disposal, is it?
Uh, not really.
Not really. Okay, never mind. I'll do a chapter on disposal after this. Okay, so don't worry. We will come back to this in the next class.
Okay.
Let's go back to this. Name the finance. So before you go through the next class, there's a video on the channel where I talk about disposal, asset disposal video. So you can actually watch that, and then when we do the class, it'll be easy for you. Okay.
Okay.